Hi, now that the election news has settled down and markets have settled up, there's a whole lot going on. This is, if anything, for us, a humble reminder of the impossibility of predicting the future, especially when it comes to elections and politics and financial markets. So Steve and I want to take a few minutes to just sketch out exactly how this impacts our clients and what we're doing differently in client portfolios and what we're thinking about and trying to figure out in real time. So with that, Steve, high-level thoughts as we look at client portfolios, what is different and what is not different now that the election is behind us?
Regulation. We're seeing a concerted effort by the new administration to reduce regulatory burden. That should help smaller companies that often have a more difficult time complying with many rules and regulations in certain industries, whether it's regional banks, whether it is regulations involving drilling for hydrocarbons. So we are likely to see an increased openness to explore for and extract minerals, petrochemicals on U.S. soil. And that could be lithium ion mines that exist here versus doing it in a more dirty way in South America or even China, or producing more natural gas domestically in the United States that is being used to create electricity, in some cases for increasing electricity demand. And that's an actually interesting point. With all this infrastructure, and manufacturing increase, add to that some of the data center growth we're seeing for artificial intelligence centers that need training or logic or inference. Add to that potential things that we're talking about for cryptocurrency and blockchain, and add to that an electrification of transportation that we're still seeing. Even if we have plug-in hybrids, it's still more batteries and more electricity consumption. So all of this combined would lead us to believe that less regulation is going to help increase the consumption for natural gas. We've talked ad nauseum about how much we like nuclear energy. We think that is a benefit. We're seeing multiple plants that have been shut down turn back on. Microsoft signed a multi-billion-dollar deal with Constellation Energy to turn back on 3 Mile Island, which is the only plant in the United States that actually had a radiation release. Take that, which is a signpost that we never would have expected a few years ago. And then not to mention multiple what's called SMR, small modular reactors that are being considered, designed, and being put in place across the country for where we might need very steady 24/7 power for certain applications. So from that standpoint, if you're in those spaces, there's a lot of activity, there's a lot of growth, there's a lot of money going to work. And then finally, Trump is a real estate guy, and we do still believe we have a housing shortage, particularly for families, residential, multifamily, and we wouldn't be surprised to see continued and potentially incrementally favorable rules for development and construction. And then you have Howard Lutkin, who was just named Commerce Secretary, who has self-admittedly owned a couple $100 million of cryptocurrencies. So we are likely to be neutral.
Wow. Individually, he's actually not seen him that much.
So he was in charge of the transition team, or was senior in charge of the transition team, and is just named Commerce Secretary. So I think we're going to see a much more supportive backdrop and a friendlier regulatory environment for innovation in that whole space, which is great. We would love to see innovation happen on U.S. soil, regardless of what real-world applications there ultimately are. That'd be great that it happens here versus in Singapore or in Europe or in Latin America. So we have owned cryptocurrencies, blockchain exposure for clients in the form of publicly traded tokens and or ETFs. That's clearly done well as of late. Depending on outcome, we want to kind of sit and observe, but we are in no rush to trim any of that exposure, I think is our current view. And then it leads to the thought process of, do we want to potentially have more exposure maybe in some of the companies that might be involved in the rails of blockchain that can help develop effectively Web 3.0 applications. So that's one that we have exposure, it's done well, we're holding tight, and we're potentially looking to see if there's other ways to play.
Yeah, absolutely. And just to summarize, at the margin, no question, it's better for blockchain. And since at least, late 20, early 21 for clients, going back that far, we've had crypto as a core position, in small, albeit small, relative to the client's specific situation. We've been involved in crypto for a while. So that was something we were already positioned for. That's worked out, and no change expected there, other than extending into potentially operating companies benefiting from blockchain.
Correct. And then you roll forward to other potential let's just say policy paths of the new administration. And I mean, you and I have discussed this, that the current administration is less like the Republican Party of 10 or 15 years ago. It is less big business focused, and probably, at least the way we observe it, to have a more populist tilt to it. So, we've read J.D. Vance's book, Hillbilly Elegy, and he talks about the trials and the struggles and the hollowing out of some of these small towns in mid-America. And that is where, at least we observe, the administration wanting to bring manufacturing or more manufacturing to onshore or nearshore, which can come in the form of tariffs. It can come in the form of potential incentives for companies to reshore. It also helps that we have much better robotics and automation today than we did 15 or 20 years ago. So the labor arbitrage is less. But that's generally positive for infrastructure. It's positive for construction. It should be positive for domestic job growth and job creation. And here also we've talked about having exposure to infrastructure-themed investments, whether it's some of the commodity equities, whether it's some of the smaller or mid-cap companies in domestic indices that benefit here.
So the good news is that we were already invested in several things that have benefited, we believe, from the new administration. First, blockchain. Second, petro or old energy. New energy, meaning nuclear, and real estate. And more broadly, just infrastructure or the reshoring, as we've had for a long time a theme on infrastructure.
Agreed.
Okay, so that covers the things we've already owned that we believe will do better going forward. Let's jump now to what do we not own, or basically not own enough of, if any, that we need to actually begin looking to add to client portfolios.
This is fluid, and we are investigating and thinking long and hard. We have avoided small cap stocks for a while. They have underperformed really since 2008.
Yeah. Which is just a humbling reminder, because in 2007, as you well know, virtually every academic or any person that knew anything about markets would have told you, of course, small cap stocks outperform big cap stocks. And of course, value outperforms growth. Since 2008, it's been just the opposite. Oh, and international. International outperforms US. So small, international, and value all outperform. Everyone knew that. And here we are today, 15 years later, and it is just the opposite.
So we're thinking about whether if regulations are really relaxed, it might benefit on the margin smaller companies. If more business and more manufacturing and more activity come onshore, it generally will benefit smaller companies versus large international companies. And we're looking pretty hard as to whether we want to actually add specifically some small cap exposure today. The second area, and we're doing a little bit of this on the margin, is because of this increased need for electricity, and it's got to come from somewhere. And while solar and wind capacities will still grow here and grow globally, the type of electricity that's needed is often 24/7 available power, whether it's to run industrial facilities or to run data centers. And the only way to get that is either via nuclear, which takes more time, or natural gas added capacity. Someone recently just told us that GE and Siemens, that make the big combined cycle gas turbines, they are sold out until 2030. You couldn't give those away a few years ago. Now they're sold out as we add more capacity to burn gas to create electricity. Not only that, you're taking large aircraft engines and running those on natural gas. They're called aeroderivatives to actually increase and run to create electricity not what the original design is, even though they work fine doing that. So we are observing today those projects being planned, permitted, and put into place. That to us leads to more natural gas consumption, combined with the fact that we're going to export some in a liquefied form around the world. So those are two areas that we're at least thinking about pretty hard right now on the add side.
Got it. And then what on the exit side? What have we looked at in our client holdings that we're either exiting or thinking about?
On the exit side, we're thinking about it. We have not done anything yet. On healthcare, if we are going to reduce waste in the system, there is likely a decent amount of waste. There's always been Medicare and Medicaid fraud that might come under increased scrutiny. And if that happens, and depending on how far that goes, that's likely a negative for overall pharma profits. It's potentially a negative for hospital profits and healthcare services. It's an area we're watching, and we'll see what actually can happen or will happen, but we are observing what is being spoken about, and now the question is going to be what can or can they not do on a go-forward basis. So back to the Department of Government Efficiency. What Musk has said that they plan on cutting $2 trillion of waste in the system is just such an enormous number on a total budget of $7-ish trillion. If they can get close there, it actually calls into question some of our prior views of the only way out of our debt situation being inflation. Now, we're highly skeptical of their ability to have a meaningful degree of success on cutting that much spending, because remember, government spending is someone else's income. You are laying off government employees, you are giving some of the military contractors less money, you're giving some of the healthcare providers less money, and all of those people have employees, have profits, and that means less money spent in the entire economy, and that'll have ramifications. That will actually likely have recessionary pressure initially until some of those employees find new jobs in hopefully more productive ways. Whether they can do that or not, that's beyond at least our pay grade and seems like a difficult task. We are open to the thought of a possibility that could happen. And here, to your point, we have to be really open-minded on the potential outcomes.
I mean, you're multiplying probabilities, yeah. And I think the first probability is Trump actually going to be getting along with Elon Musk within 3 months, let alone 3 weeks?
Two black holes in one room, usually one black hole consumes the other, right?
So, yeah. So number one, you have to believe that there's a good chance of that. Then you have to multiply that probability by, okay, they stay friends, they're a united front, they're going to go for this goal. Can they actually make traction? To your point, Reagan tried to get rid of a lot of spending, and number one, the Department of Education is still around, but the total government spending did go up under Reagan. So I remain a skeptic that government spending actually goes down over time in any material way. I'm in that camp. But clearly, if that does happen and surprises me, the thesis that we have had, really going all the way back to 2015, of financial repression, which means we have been operating under the assumption that regardless of whether you have Republicans or Democrats controlling Washington, they are effectively locked into a political course of deficit spending, and somebody has to pay for that spending. We do that by issuing government bonds, and somebody has to buy those bonds, but with even Japan at the margin stepping away and China stepping away, we have assumed that the buyer of last resort is effectively ourselves, meaning the Federal Reserve. And if the Federal Reserve is monetizing our debt, that's called financial repression. That leads to asset inflation. So that has been Fielder's playbook effectively since 2015, and it's worked. But if we actually cut the deficit materially or even just stop its growth, then we are getting out of the debt trap, and our financial repression thesis would be wrong, in which case we are going to have to pivot. So here's the question. I never, can we predict this? I never in a million years would have predicted that we would have had a red sweep, complete sweep. We had been operating under the assumption we'd have a divided Washington. That has not been the case. With the red sweep, now you have to ask, can we actually cut deficit spending? I'm a skeptic, but if it happens, we have to be observing this in real time. And if it is happening, this needs to change our thinking. So that leads to the question, if tomorrow we waked up and said, holy wow, we're not in a debt trap anymore, financial repression is off the table, how would that shift our investment strategy? What does that mean?
Let's continue down the thought experiment, because I think you and I would both agree that this is not likely, but we want to be open to the possibility. What would that look like? If they're going to be successful, it's like an investment in private equity. You have a big J curve, which means you're going to wind up laying off a lot of people to start, and then in theory, we are going to have more productivity and growth coming out the back end. 10, 20 years from now, really good for America. First couple of years, tough pill to swallow. So if they're going to do it, we're going to see it early. And that's the only way they can do it, because they are not idiots. They know they have the midterm elections coming up in 2 years. So they have to do as much as possible immediately. So we're going to get to observe this live in the very beginning of the year. If they were to do this with enthusiasm and full force and not hit every single entity that is fighting for their lives, pushing back against them, every single lobbyist in Washington, every large industry group, everyone is going to fight this tooth and nail.
That's important, because I think most people, your gut reaction is, well, it's just the entrenched government bureaucracies that are going to be fighting this. We believe the level of cronyism is so large, big companies, industry incumbents are going to be fighting this.
Mm-hmm. So let's say they still win over that. What's it look like? It means that GDP drops substantially or meaningfully in the beginning of 2025. People will know why. There'll be pain. Unemployment will go up. There will be less inflation and less inflationary pressures. Let's call it disinflationary pressures.
Which means very low interest rates.
Which means likely unemployment up, means interest rates are going to drop more than what the market is pricing in that scenario. Mm-hmm. So even if it is ultimately successful, it will not feel that way at all. So in that scenario, unless they do something that you and I aren't talking about to stem that J curve, that down swoosh before we hit up, that would be likely negative assets.
My question or my skepticism is, what happens to the political support? We get 6 months into this and unemployment's up dramatically. Government services are being cut because, again, people are not going to just get laid off and go away. These organizations are going to, in my view, stage shutdowns of basic government services to demonstrate fairly or unfairly the impact of these layoffs. And one statistic that stands out to me on the election is, despite Trump's electoral college victory, the number of voters roughly for Trump actually did not go up. Rather, the number of voters for the Democratic Party went down. So the question is, if things get really ugly, does that allow him to have the political positioning to push through what will be a very tough pill to swallow?
An old boss of mine at Goldman, Chip Otness, to you, said there's one thing politicians care about, it's getting reelected. So if you are a congressman or a senator and your constituents are getting laid off, you have no loyalty to this program. you'll fight it, whether you're red or blue?
I definitely remain a skeptic that we see material declines in deficits. So for the time being, we are, and to be clear, if we have financial repression, it's good for asset prices over time. And indeed, that's been the case. If we don't have financial repression, but we actually get out of the debt trap, deficits go to zero, that is amazing for real economic growth, which does not necessarily come with financial repression, which is also good for assets. Now, the mix of what assets do really well in either of those scenarios is slightly different, maybe in some cases materially different, but the point is you want to own assets under either scenario.
Completely. Path may change. May we live in interesting times, because we sure do. It will be very interesting to observe the facts as they come out over the coming weeks and months.
The bottom line is we have to stay completely flexible and open-minded and fluid. And one of the things I'm very happy to have right now is a completely open, flexible mandate. And I think as investors, the ability, number one is the mindset to be willing to go and do anything, go anywhere, do anything that is benefiting from the new environment that we may find ourselves in, but also just having the ability structurally as an organization to use any custodian to be, whether it's public securities, private securities, I think is more important now than ever. And I'm biased, of course, but I believe that we have a structural advantage as an independent RIA, and I'm glad to be in this seat.
Cheers to that.
Was that overtly overselling ourselves? I'll take it. I'll take it. So with that, we do encourage clients to please reach out with questions as you have them. We are watching this in real time with you. We are trying to be mindful of not trying to predict, but instead trying to observe. And we believe that is the path to success going forward. Observe, don't predict, and stay open-minded and stay flexible. With that, thank you for your patience through what may be rough times in the year ahead. And hopefully, regardless, we come out on the other side as winners.